This question will walk through subsequent events. On December 31st, 2020, Mountain Corp has assets of 10 million, liabilities of 6 million, common shares of 2 million, representing 2 million common shares of $1 par, and retained earnings of 2 million. Net sales for the year were 18 million and net income was 800,000. As one of the auditors of this company, you are making a review of subsequent events on February 13th, 2021, and you find the following. 1. On February 3rd, 2021, one of Mountain Corp's customers declared bankruptcy. At December 31st, 2020, this company owed Mountain Corp 300,000, of which 40,000 was paid in January 2021. Let's just take a look as we're going through this long question. Let's take a look. Let's jump right down to the bottom. And it says, for each event, state how it will affect the 2020 statements, if at all. The company follows IFRS. Okay, so as we go through and read each one, let's also address how it will impact the financial statements. So we just talked about the fact that Mountain Corp's customers declared bankruptcy and that at December 31st, that this customer owed Mountain Corp 300,000, of which 40,000 was paid. So what should we do for the financial statements here? So it says the financial statements, you were looking for financial statements on February 13th, 2021, and you're the auditor. So what that means is that the financial statements have not yet been issued because presumably the auditor is looking to just finalize their audit opinion. So it's this February 3rd, so it's prior to that date. So we know it's prior to the date of the issuance of the financial statements. And what we found out here is that so there's two types of subsequent events, those that relate to balances that existed at the financial statement date and after. So this is something that existed at the statement of financial position date because we would have had this AR on our books. And now we know that this company declared bankruptcy. Luckily, we already got paid 40,000. So we have 260,000 at risk. And so we're going to need to write off that 260,000. So we would adjust the net realizable value of AR to 0. So basically we would write off 260,000. So we would adjust for number 1 because that existed at the statement of financial position date. What about this one? On January 18th, 2021, one of the client's 3 major plants burned. Mountain Corp has fire insurance. Well, did the fire relate to something that existed at the statement of financial position date? No, of course the fire would have happened after, but it is material, so it should be disclosed in the notes of the financial statements. Disclose in the notes. So this is number 1, and we're going to adjust. Okay, so number 3, on January 23rd, 2021, a strike was called at one of Mountain Corp's largest plants, and it halted 30% of production. As of today, the strike has not yet been settled. Well, strikes are considered general knowledge, and therefore specific disclosure is not required. However, disclosure is suggested, so let's just go with disclosure in the notes. Okay, no adjustment for that. Number 4, a major electronics enterprise is introduced a new line of products that would compete directly with Mountain Corp's primary line, now being produced in a specially designed new plant. Because of manufacturing innovations, the competitor has been able to achieve quality similar to that of Mountain Corp's products, but at a price 30% lower. Mountain Corp officials say they will meet the lower prices, which are barely high enough to cover variable and fixed manufacturing and selling costs. Well, this is an interesting one. Now, did this position exist at the statement of financial position date or after? Now, I believe that this position existed after the statement of financial position date, and this is more about general business competition. So I would say no disclosure. Required. General business. Okay, Number 5, the merchandise traded in the open market is recorded in the company's records at $1.40 per unit. The price held for 2 weeks after the release of an official market report that predicted vastly excessive supplies. However, no purchases were made at $1.40. The price through the preceding year had been about $2, which was the level experienced over several years. At January 18, 2021, the price returned to $2 after public disclosure of an error in the official calculations of the prior to December. The public disclosure of an error in the calculation erased the expectations of excessive supplies. Inventory was on a lower of cost and net realizable value basis. That's interesting. So it was supposed to be $2. So we recorded it in the company's records at $1.40, but then we found out that that was wrong and it was supposed to be recorded at $2. Now, it doesn't seem that there were any purchases made at this amount because it says, however, no purchases were made at $1.40. So this is basically just about quoting, merchandise quoting. There weren't actually any purchases made at the incorrect amount, so no disclosure is required. So we're going to say 5, if no revenue error, no quote only. Basically meaning that they don't need to disclose anything for that, because that's really just going along with general business, unless they're saying that they had inventory at $1.40 and then they realized that it should have been at $2 and that was an error. Of course, that would have to be corrected. Number 6, on February 1st, 2021, the board of directors adopted a resolution to accept the offer of an investment banker to guarantee the marketing of 1.2 million of preferred shares. This number 6 will be in a note. This did not exist at the statement of financial position date, so disclose in notes. And number 7, the company owns equity investments classified as current assets, accounted for using the fair value through a net income model. The investments have been adjusted to fair value at December 31st. On January 21st, the annual report of one of the investment companies had been issued for its year ended November 30th. The investee company did not meet its earnings forecast and the market price dropped from $49 per share to $27 per share. The drop in the market price did not exist at the statement of financial position date, even though I know it's tricky because the audit report for the investment is at November, which is obviously prior to the statement of financial position date, but the decline in value is post the financial statement, is post the statement of financial position date, meaning we wouldn't adjust it because it was after the financial statement date, but we would disclose it in the notes if it's material. And the materiality goes across all these assumptions, disclosed in the notes if material. And that concludes this question.